Hello, and welcome to the September 2024 monthly market update. My name is Steve Latham. I'm the Chief Investment Officer for Bernanke Wealth Management. And this month, we're going to be talking about jobs growth in the economy and the Federal Reserve's reaction to new data leading them to a rate cut campaign in the not too distant future. So let's dive right into it. There's a great consumer report card from Bank of America that comes out on a monthly basis that anyone can go out and look at. We read it regularly, and it gives us insight into what consumers are doing at a baseline level for spending, unemployment, and if they do or do not have the ability to find jobs. And within this report card, we've highlighted a couple charts that Bank of America provides us. Firstly, on the left, it shows in the blue line the month-over-month number of new jobs that have been created in the economy. And we can see very clearly over the last couple of years, the number of monthly jobs created have been decelerating. They're still positive. We're still creating jobs, but the number of jobs every month that we've been creating has been fewer and fewer month over month. And in the red line, we can see that also through the unemployment rate. Just over the last 6 to 8 months, we've seen the unemployment rate tick up quite surprisingly high to most recent number at 4.2%. Now, part of this is because more working age individuals are entering the job market, which is a positive for the overall economy to see more people participating in the market. But nonetheless, it shows that there are still perhaps not favorable jobs for those individuals that they're looking for because they are still seeking jobs and they have not taken themselves off of unemployment. We can also see that in the chart to the right, where the number of individuals who are obtaining unemployment insurance from the government has come down since the middle of 2023, but has started to creep higher. And all that tells you is that, yes, more people are entering the workforce, or at least seeking to enter the workforce, but they're having trouble doing so. And as a result, they are starting to take those unemployment benefits in order to help bolster their discretionary income. Now, the Federal Reserve is obviously paying attention to this. They have been paying attention to unemployment for quite some time now that inflation has come down substantially from its peaks. And in the most recent speech from Jackson Hole, Federal Reserve Chair Jerome Powell gave the following statement, and we'll just read part of it here for you today. Overall, the economy continues to grow at a solid pace, but the inflation and labor market data show an evolving situation. The upside risks to inflation have diminished and the downside risks to employment have increased. What Jerome Powell is telling you there is they are focused significantly more on the employment picture of their dual mandate versus the inflation piece of it, as they believe inflation is on a sustained path downward. Jumping to the next paragraph. The time has come for policy to adjust. Boom, mic drop. That is Jerome Powell saying we are going to start cutting interest rates because they believe their their monetary policy is too tight. So at their next meeting in September 18th, the expectation is that they will begin that rate cutting campaign. It is yet to be seen if it's 0.25% rate cut or 0.5% rate cut. But the fact of the matter is they will begin cutting rates as a result of the risks that they see to unemployment increasing in the near term. Finally, he concludes this statement with the current level of our policy rate gives us ample room to respond to any risks we may face, including the risk of unwelcome further weakening in the labor market conditions. Again, he's reiterating the labor market conditions and not focusing on the inflation piece of the Fed's mandate picture. So there again, suggesting that if unemployment does start getting away from them, they have ample space to conduct policy changes, i.e. lower interest rates, in an effort to bolster businesses' ability to go out and hire more individuals in the economy. Bottom line, what does that mean for us in the markets? Well, really, that just tells us that we are going to be in an easing cycle, which means money, or the cost of money, as in the amount of interest we pay on borrowing, should be coming down as a result of the changes the Federal Reserve is making, which should also help the consumer not only borrow for any projects that they may have at home, but businesses hire those consumers in order to allow them to continue to spend in a healthy manner. And finally, another data point to reiterate this, as far as the health of the consumer is concerned, yes, the unemployment rate's ticking up. Yes, the amount of jobs created month over month are not as high as what they used to be, but those who do have jobs are continuing to see their wages grow year over year. And this chart again comes from the Bank of America Consumer Report Card, and it breaks it down by demographic of income. So the blue line are those individuals making less than $50,000 a year. The red line is between $50,000 and $125,000 a year. And then the yellow line is $125,000 and above a year. And this tells us the rate of growth of their wages year over year. And as we can see, again, it's slowed quite a bit since the middle of 2023, but it is still positive for all three cohorts. And in fact, the highest earners from Bank of America's survey are now seeing their wages grow more than what they did even just a year ago. So again, this paints a picture that we shouldn't be terribly concerned with the state of the consumer right now as far as employment is concerned. Yes, it's slowing, but it's not negative. If we see wages start to fall from their current state as a growth space into a negative space, that would certainly be concerning. And of course, if we see jobs growth turn negative as well, meaning that companies are starting to slash jobs as opposed to continuing to hire, that would be another negative sign for the consumer and the economy as well. But right now, we believe we are on a trajectory of slower, albeit still positive growth for the economy. And the consumer, as we can see, is maintaining their spending power, as that's one of the largest components of economic growth for the United States. If you have any other questions around the state of growth for the United States or the state of the consumer, we're always happy to answer those for you. Please feel free to reach out at any time. Thanks for joining us.